What is going on, everyone? Welcome back to another YouTube video. In this video, I want to talk about, do indicators really work? I get asked this question a lot. Are indicators laggy? Do they work? Are they reliable? And so many other questions that I want to cover in this video for you guys. For those of you who don't know me, my name is Jerome. I'm a full-time Forex trader based here in Sydney, Australia, and I'm also working alongside Austin Silver as an ASFX coach, helping struggling traders become profitable. I'm excited for this video. I get so many questions regarding this topic. If indicators work in the Forex market, what are indicators? Are they reliable, like I was just saying before? So I'm pumped. Let's get into it. The easiest way and the most simplest way to answer the question of do indicators really work is simply yes, they do. But there are things you have to be aware of, and we're gonna go through those in the video now. What you should and what you should not do with trading technical indicators. Now, I'm sure you have heard in the trading space a lot of people or a lot of misconceptions around indicators, and you may have heard people say trading indicators are stupid, indicators don't work, indicators are laggy, something along those lines that have turned you away from using them. Unfortunately, that was me for 18 months of trying to learn price action, trying to create and define rules, systematic rules around price action, and it did my head in. I struggled a lot trying to find my way in the market, how to navigate the market on lower time frames, and it was just a headache. Unfortunately, I never questioned this because I heard this from a supposedly successful trader. They were telling me indicators don't work, you don't need them. So I went along my trading journey, trading price action. And for me personally, which we'll get into this in a minute, me as a trader, my trading personality, I don't like trading straight price action. It's just not for me. I needed something to help me navigate the market. And the truth is, there's nothing wrong with that. There is nothing wrong with having an indicator on your charts to help you navigate the financial market. And now I'm gonna get into some really cool details and how we can use indicators to generate highly probable, successful trade ideas and how you can utilize them to make your life easier. Because the truth is, trading can be as hard as you want or as easy as you want. There is no correct way to go about it. So it's whatever fits you and your personality. Before we also get on with the video, you have to remember that some people may not like indicators, and that is completely fine. You don't have to listen to what other people do, other people's opinions, other people's thoughts on the financial market. You have to do what suits you and you only. So I'm sure a lot of you have heard my story. I was, like I was just saying before, 18 months trading price action, developing trading strategies and back testing, only to come into the live market and completely fail trading it because I didn't have the confidence. I didn't have any kind of reassurance or confluence with what I was doing. I simply had no rules. It was so subjective for me going into the live market. I questioned everything, leading to a lack of confidence. And then that just really left me feeling frustrated. So I hope some of you can relate to this, since this is really important. And I really want to get this message across to a lot of struggling or beginner traders. There is nothing wrong with using indicators. And I'm about to, later in this video, we're going to go through the charts. I'm going to show you what to do and what not to do, because unfortunately, a lot of people think chucking it, like the RSI indicator, for example, as soon as it goes oversold, they place a buy order. That is not what you want to do. That's a big no-no. Don't just, because an indicator is giving you a bullish or bearish signal, does not mean you have to go open MT4 and place a buy or sell order on that one little thing telling you what to do. We must stack confluences, stack multiple confirmations in order to generate the best, highest probability trade to go in our favor as possible. Trading purely indicators is not the way to do it. So let's get into that now. Also, a quick note, I was introduced to EMAs when I first joined ASFX, and that is what has made me profitable. As soon as I introduced EMAs to help me navigate the market, my whole trading approach changed dramatically, and it was a complete game changer for the way I approached the financial markets, the way I read a price chart, the way I did my technical analysis. Everything changed, and it was the best thing that could have happened to me. So please have an open mind as we go forward in this video, and question everything as well. And I'll be happy to get back to you. Drop a comment in the comment section below, letting me know your thoughts on this topic. So a quick example of what a technical trading indicator is. An indicator is something that gathers price data, such as moving averages. That will gather the data of price using mathematical equations to present with moving averages a line on the chart. That will tell you what is happening in averaging out price. There is multiple different types of moving averages you can use. You can use simple moving averages, exponential moving averages. There is a few you can choose from, and they all have a different purpose. I personally like using exponential moving averages since it weighs the most recent price data more heavily, giving us more weighted and recent data on the EMA so we can make better trading decision on what's happening now, not what happened like 50 days ago. Using the EMAs, I could now jump into my charts and gather, are we bullish or bearish? I could gather trends within a few seconds. I could even go as far as knowing when I should be trading. Are the EMAs stacked? Are we very bullish? Should we be waiting for a pullback? All this information was now clearly in front of me on the charts by looking at a simple pair of lines. I could easily gather key levels of dynamic support and resistance because EMAs act as support and resistance. We're going to go into the RSI as well. So the RSI is an indicator that will tell you if the market is oversold or overbought. Theoretically, a market can never be oversold or overbought, but it is definitely a good indicator to have because it can just help you make better trading decisions. Now, once again, never purely trade based on an oversold or overbought condition. That will, that won't be good. So don't do that. But anyway, that is a long version of if indicators do work. Yes, they do. So now let's kind of go in and more of a deeper insight on what you should be doing and what you shouldn't be doing with indicators. So like I just said before, never take a position based off one parameter. Like I was saying, RSI, do not just take a trade based on that. I see a lot of people do this, unfortunately, and they always question that the indicator doesn't work. Of course, it doesn't work like that. You have to stack multiple confluences in your favor, multiple confirmations of what's happening with price action, support and resistance. They are mostly the two of the things I use in my trading these days. I don't like to overcomplicate it. I keep it as simple as possible. So support and resistance, which are key levels, EMAs, and more or less the TDI indicator, which is the Traders Dynamic Index. I've done videos on this before, so I'm not going to touch on it too much, but it's basically an RSI indicator with a few moving averages that just gather data from price, EMAs, and everything to give me the bigger picture of what's happening inside the market. So always use a technical indicator with price analysis. Doing your technical analysis, you want to do your technical analysis using the price chart, the candlesticks. What is price telling you first? Then come to the EMAs and then get the bigger picture or the RSI or whatever indicator you're using second. You don't want to use your indicator first unless you are more or less scoping out and finding high probability trades, which we'll get to that in a minute. But that is kind of the main principle you want to follow. With the RSI indicator, as soon as it goes overbought, I'm going to give you guys a quick example right now. With the RSI indicator, this is TradingView. This is my charting package I use. TradingView is completely free, which is awesome. So if you want to follow along, and I'll show you guys an example. So with the RSI, if you go to indicators up here and you type in relative strength index or RSI, you'll get the RSI indicator down here. The RSI is technically overbought above 70 value and is technically oversold below 30. So when this purple line dips out of this highlighted area below the 30, the RSI is now considered oversold, and above, which is over here, it's considered overbought. So now if you were to take a trade purely based off the RSI going overbought, so let's just see what happens here. So you can see now the purple line is now above the 70 value. If you were to take a sell order expecting price to come lower, and then you had, for example, let's just say a 30 pip stop loss, let's see what would happen. You would have been stopped out. This will happen more times than not if you are taking trades purely based on the RSI or any indicator alone. Now let's see what happens when you use it correctly and start stacking price action, support and resistance, and other dynamic confluences and confirmations in your favor, so we can only take high probability trades, being more selective, filtering out all the other worse off trades that you should not be involved in. So this exact same entry coming back to the charts, you will see now. Let's go back and see what we can see using just simple technical analysis, support and resistance. You can see over here, there is a support zone up here, resistance, and over here as well. So now instead of waiting just for the RSI to go overbought, why don't we wait for price to come to this key level, this key resistance level in the market, and see what happens with price action. So let's just play it forward a bit. You can see price is rejecting at those levels. Let me just turn this off real quickly. You can see we pinned up that level. So now, if I was a price action trader, I would wait for a retest of this high. Right there. And I would probably get involved on this lower low, lower close candle here with my stop loss above there. And then I would measure risk to reward, and I would see the potential reward I could get from taking a trade like that. All right. And as you can see, the trade would be in profit and we would hit targets. Now let's go one step forward. What about chucking in EMAs? So the yellow line you see here is the 8 EMA, the red line is the 21, and the blue line is the 50. Now we can even create more rules-based systematic entries. Now let's say I wanted price to break the 50 EMA. If the price breaks the 50 EMA, it means the short-term uptrend or the medium-term uptrend is failing. Price is reversing, the trend is more or less over. So the 50 EMAs is pretty much the bull's last stand. If the bears can break below it, which it did in this example over here, I would expect price to keep falling. And this is how I trade. I trade using candle formations, a combination of support and resistance and price action to generate the highest probability trade ideas I can possibly make. It helps me be more selective just by using a few indicators, and I can generate very clean, very systematic, very defined rules around my trading. So I can come into the market every day with complete confidence, knowing what I'm doing, when I'm getting involved in the trade, where I'm putting my stop loss, and where I'm going to exit. That's how you want trading to be. You want trading to be as systematic, rules-based as possible. Otherwise, you're going to let emotions and get involved and psychological issues get involved when you start to lack confidence, when price starts going against you. You don't want none of that. So having a systematic approach in the market is your key to success pretty much. So back to this example over here, you can see this candle for massive bearish bar breaking below previous consolidation. This black line you can see broke below all those candles there. That would be a typical entry I would take. I would put my stop loss just above the candle. So entry candle there, and I would measure risk to reward down to these lows over here. And as you can see, price took out my targets with ease. I never went into any drawdown. So as soon as I entered on this candle here, price instantly went in my favor, hitting targets. So with this example, this is a great example of how I trade. I still use price action, I still use support and resistance, but I'm using indicators to help me navigate my way through the financial market. Now, I'm going to give you a quick example of our indicators lagging. And this is a great example of what people mean by that. And I'm going to tell you why it doesn't matter and why you shouldn't care if an indicator lags. Now, most people would probably get into the trade probably around this area up here. Let me just get rid of these. So support and resistance traders, they would see price coming up to this resistance zone we have drawn here. They would see this retest and they would take the first sign of rejection they can, which is over here, and then the retest. They'll put their stop probably above the resistance, and then they would write it down to the lows. You have to remember, with trading, you are never going to catch the full move. With that mindset, you're not going to want to catch every single pip that you possibly can. I rather enjoy taking small, consistent wins, fewer losses, and riding the trend. But you got to remember, you're never going to catch every trade. You're not going to catch the top. You're not going to catch the bottom. So why would you care if an indicator is lagging and you miss out on a little bit? I would rather miss out on a little bit of the trade than to get stopped out, affect my emotions. I would rather be more confident, stack more confirmations, have a better systematic system, more rules-based, than to try and catch a few extra pips. That is the way I like trading, and I recommend a lot of people try and take this approach. Let me know in the comments if you disagree, please. I'm always happy to kind of discuss and understand other people's perspectives, but I would rather miss out on 4 or 5 pips than to take a loss or not have confidence in my execution, or to have gray areas in my trading plan, or, you know, to enter based on emotions, FOMO. I would rather wait for my system to tell me when to enter, where to put my stop, and where to get out. That's just my type of trading. That is how I think all trading should be done. Systematic and rules-based. So you have to remember, if an indicator is lagging, it's not what indicator you're using, it's how you are using that indicator. Just like I said before earlier in the video, never rely on a buy or sell signal based on one indicator alone. Like this example I just showed you, stack as many confirmations in your favor as possible, wait for your system to tell you when to enter, and then jump in on the trade. It's going to give you the highest probability and the highest success rate. It's going to increase your win rate. It's going to decrease the amount of losses you take, and it's going to make you overall profitable in the long run. An indicator is not going to predict the market, and you should never be trying to predict anything in the financial market, because once again, we never know what's going to happen in the financial market. We just don't know what's going to happen. You must be using an indicator in your overall system or strategy. Don't just use an indicator purely because it's telling you to buy or sell. That is not going to make you profitable in the long term, unfortunately, and you shouldn't be doing that. So yes, indicators do lag, but it really doesn't matter. So I hope you guys got some value out of this video. If you did, please smash that thumbs up button and subscribe if you haven't already. I really want to get this message across because unfortunately I went through a lot of hard times and on a hamster wheel because I was told indicators don't work. As soon as I found a great mentor to kind of teach me how to use them correctly, my whole trading changed. It was just a complete game changer on how I approached, how I viewed the charts. It made my technical analysis so much easier. It made how I develop my watch list and pick out high probability trades a lot more simpler, because I can just gauge what's happening in the market by looking at a few indicators. Once again, I'm not taking trades just because one indicator tells me to. I'm still stacking support, resistance, still looking at some candle formations. I'm looking at rejections to certain key levels, and I'm waiting for the market to show me its hand before I jump into any trade that presents. So I hope you guys got some value out of this video. Once again, please subscribe if you're not subscribed. Hit the bell icon so you get notified when I release any new content. Once again, I appreciate your time, and I'll see you in the next video.